It wasn't a sudden industrial shortage, it wasn't a speculative frenzy on Wall Street. It wasn't even a coordinated squeeze by retail traders, it was the silent, terrifying recognition that the currency itself had broken. The charts tell one story, history tells another. When a monetary metal begins to move in silence, without headlines, without hype, it is rarely a signal of market optimism. It is a smoke alarm. The pattern is unmistakable. We are looking at a recurring historical cycle, a sequence of events that has destroyed empires and wiped out the savings of the unprepared. The arithmetic is merciless. Governments overspend, debts become unpayable, the currency is diluted to cover the gap, and then the flight to safety begins. Silver does not rise in a vacuum, it rises when faith in paper falls. The incentive is survival, the payoff is preservation. Under these constraints, the rational move is to exit the system before the gates close. Most observers agree. We are seeing early signs of this rotation now, but to understand where this ends, we must look at where it has happened before. The timeline is rigid, the outcome is mathematical, and the warning signs are flashing red. Consider the Roman Empire in the 3rd century at its peak. Rome was the master of the known world. Its currency, the silver denarius, was the standard of global trade. It was pure, it was trusted. But the costs of empire were staggering. The military budget exploded, the bureaucracy swelled. The emperors faced a choice: cut spending and risk a coup, or fake the money. They chose the shortcut. Under Nero and his successors, the silver content of the denarius was systematically reduced. They mixed in copper, they mixed in bronze. By the time of Aurelian, the coin was a washed-out token containing less than 5% silver. The government minted millions of them to pay the legions, but the market was not blind. Merchants demanded more coins for the same wheat. Soldiers demanded higher wages to buy the same boots. Inflation ripped through the empire. The middle class was obliterated, and what did the citizens do? They hoarded the old silver, they buried the real money in the ground and spent the worthless bronze. The flight to hard assets was not a trade, it was an act of desperation. Just like Rome, the Weimar Republic in early 20th century Germany faced an unpayable bill. The debt from the First World War was crushing. The reparations demanded by the Allies exceeded the nation's ability to pay. The industrial base was shattered. The tax revenue was non-existent, so the government turned to the printing press. They believed they could print their way to solvency. For a brief moment, it seemed to work. The stock market soared in nominal terms, employment stayed high, but the currency was rotting from the inside. By 1923, the illusion collapsed. The paper mark became worthless paper. A loaf of bread cost billions. But notice what happened to silver and gold. They didn't just rise, they became the only things that mattered. A family with a small stash of silver coins could buy a city block in Berlin. The pensioner who kept his savings in government bonds starved. The farmer who held hard assets survived. The lesson was brutal. Paper is a promise, silver is possession. Just like Weimar, the British Empire in the 20th century watched its dominance fade into debt. From 1914 to the 1970s, the British pound lost its status as the world reserve currency to world wars, and the construction of a massive welfare state drained the treasury. The government responded by devaluing the pound against gold and silver repeatedly. They employed capital controls. They restricted the movement of wealth, but the arithmetic caught up with them. In the 1970s, inflation spiked, the economy stagnated, and once again, silver made a historic move. While the headlines focused on the Hunt brothers and speculative corners, the broader trend was a wholesale flight from sterling. Investors, savers, and institutions realized that the government's promise to pay was worth less than the metal in the ground. The purchasing power of the pound collapsed. Those holding paper assets saw their wealth evaporate. In real terms, those holding metal preserved their purchasing power. Through the storm, the pattern repeats in 7 distinct stages. Stage 1 is sound money. The currency is backed by something tangible, usually gold or silver, and the government runs a balanced budget. Trust is high, and the economy grows on real productivity. Stage 2 is overreach. The state expands its ambitions, whether through war, welfare programs, or imperial expansion. The government commits to spending far more than it can tax. Deficits begin to accumulate, but they are dismissed as temporary. Stage 3 is debasement. The government realizes it cannot pay its debts honestly. It faces the choice of austerity or inflation. The political incentive is always to inflate in the ancient world. They clipped coins in the modern world. The central bank expands the balance sheet and suppresses interest rates. To monetize the debt, stage 4 is the asset bubble the newly created currency flows into. Financial markets first, stocks rise. Real estate prices climb, the wealthy feel richer. And the politicians claim credit for the boom, but this prosperity is an illusion, built on currency dilution, not economic production. Stage 5 is price inflation. The excess currency finally leaks into the real economy. The cost of food, energy, and services begins to rise. The government blames speculators, supply chains, or foreign adversaries. They deny that the currency itself is the problem. Stage 6 is the flight to hard assets. This is the stage where silver quietly makes its big move. The public realizes that inflation is not transitory. Confidence in the currency fractures. Capital flees from bonds and cash into anything that cannot be printed: land, commodities, gold, and specifically silver, which often acts as the high beta chaotic responder to currency failure. Stage 7 is the reset. The currency collapses or is redenominated. The debt is restructured, often at the expense of bondholders and savers. A new monetary system is introduced to restore confidence, usually anchored back to hard assets or a new reserve currency, just like the British Empire before its final pivot. Current data suggest we are deep into this cycle. Global debt levels are at historical highs. Central banks have normalized the monetization of government deficits. The purchasing power of major currencies is eroding at a pace that official metrics struggle to capture, and silver is moving. It is moving not because we need more solar panels, though we do. It is moving because the smart money is positioning for stage 6. The risk is that you are watching the price of the metal while you should be watching the value of the currency. Some economic historians note a common counter-argument. They argue that modern central banks have tools that Rome and Weimar did not. They argue that silver is merely an industrial commodity, driven by manufacturing cycles, not monetary fear. But think about the incentives. If silver were purely industrial, its price would track global manufacturing output perfectly. It does not. It tracks the expansion of the money supply and real interest rates. When the yield on holding currency turns negative in real terms, the opportunity cost of holding metal disappears. The industrial demand provides a floor, but the monetary demand provides the explosion. History shows that when the public loses faith in the ledger, they return to the physical. The end game arrives in one of 3 ways. First is controlled decline. This is the path of financial repression. Governments keep interest rates below the rate of inflation for a decade or more. This slowly liquidates the real value of the debt and the real value of your savings. We saw this in the United States and United Kingdom following World War II. Nominal growth looks okay, but your standard of living slowly bleeds away. Silver tends to perform well here, grinding higher as it tracks the true cost of living. Second is chaotic collapse. This happens when the bond market revolts. Investors refuse to fund the government's deficit at suppressed rates. Yields spike. The currency crashes. The central bank is forced to print everything to stop a default, triggering hyperinflation. This is the Weimar scenario. This is Venezuela. In this scenario, silver essentially goes to infinity in local currency terms, not because silver is worth more, but because the currency is worth 0. Third is reset and restructure. The system is acknowledged as broken. Debts are written down or forgiven. A new currency is issued, perhaps linked to a basket of commodities or a digital ledger. This happened in Germany in 1948 with the introduction of the Deutsche Mark. Holders of the old currency were wiped out. Holders of goods and hard assets carried their wealth through the portal. The only variable is timing and pain. Subscribe to follow the signal. Study the history of money. Do not rely on the official narrative. Watch the data. Prepare your mind and understand that in a world of infinite paper, the man with the silver coin is the only one who actually owns his money.